1,000 points down. A sign of recession? The Dow Jones Industrial Average plummeting 1,000 points in a single day is certainly a jolting sight. It sends shockwaves through Wall Street and beyond, leaving investors and ordinary citizens alike wondering, are we on the precipice of a global recession? The answer, as is often the case in economics, is complex and multifaceted. While a dramatic market drop is cause for concern, it's not necessarily a definitive indicator of a recession. To understand the significance of this event, we need to delve into the forces at play in the global economy. A myriad of factors contribute to market volatility, and disentangling them is crucial to forming an accurate assessment of the current economic climate. From inflation and interest rate hikes to geopolitical tensions and supply chain disruptions, the global economy is grappling with a confluence of challenges. The recent market volatility is a stark reminder that economic stability is a delicate balancing act. It underscores the interconnectedness of global markets and the ripple effects that economic shocks can have across borders. While the Dow Jones drop is a significant event, it's essential to look beyond the headlines and examine the broader economic landscape to fully grasp the potential implications. Market volatility, characterized by rapid and significant price swings, reflects the inherent uncertainty of the financial markets. Driven by a complex interplay of factors including economic data, geopolitical events, and investor sentiment, volatility can both create and erode wealth in short periods. The recent Dow Jones plunge exemplifies this phenomenon, highlighting the susceptibility of markets to sudden shifts in sentiment. Investor psychology plays a crucial role in market volatility. Fear and uncertainty can spread like wildfire, leading to panic selling and exacerbating downward trends. Conversely, periods of optimism and exuberance can fuel speculative bubbles, driving prices to unsustainable levels. The challenge for investors is to navigate these emotional swings and make rational decisions based on sound financial principles. Understanding the drivers of market volatility is essential for both seasoned investors and those new to the financial world. By recognizing the factors that contribute to market swings, individuals can make more informed investment decisions and mitigate their exposure to risk. It's also crucial to remember that market downturns, while unsettling, can present opportunities for long-term investors to acquire assets at discounted prices. To assess the health of the global economy and determine the likelihood of a recession, economists rely on a range of key indicators. These indicators provide insights into various aspects of economic activity, from consumer spending and business investment to inflation and employment. By analyzing these data points, policymakers and businesses can gauge the overall direction of the economy and make informed decisions. Gross domestic product, or GDP, a measure of the total value of goods and services produced in a country, is a primary indicator of economic growth. A sustained period of negative GDP growth is often considered a hallmark of a recession. Other key indicators include inflation rates, which reflect the rising cost of goods and services, and unemployment rates, which measure the percentage of the workforce that is actively seeking employment. Central banks, such as the U.S. Federal Reserve and the European Central Bank, play a pivotal role in managing economic stability. They use monetary policy tools, such as interest rate adjustments and open market operations, to influence inflation and economic growth. Monitoring central bank actions and statements can provide valuable insights into their outlook on the economy and their policy responses to emerging challenges. The global economy is currently facing a confluence of headwinds, each posing unique challenges to economic stability and growth. The ongoing war in Ukraine has sent shockwaves through energy markets, leading to soaring energy prices and raising concerns about energy security, particularly in Europe. The conflict has also disrupted global supply chains, exacerbating inflationary pressures and creating shortages of essential goods. China's economic slowdown, driven in part by its strict zero-COVID policy and a property market downturn, is another significant factor weighing on the global economy. As the world's second-largest economy, China's economic performance has ripple effects across the globe. Its slowdown has dampened demand for commodities and manufactured goods, impacting economies that rely heavily on trade with China. In addition to these geopolitical challenges, the global economy is grappling with the lingering effects of the COVID-19 pandemic. Supply chain disruptions persist, labor markets remain tight in many countries, and inflation continues to erode consumer purchasing power. These factors, combined with rising interest rates and geopolitical uncertainty, have created a complex and challenging environment for businesses and policymakers alike. Please tell us what you think about this situation in the comment below. Please share, like, and subscribe.